And what happens next depends on one signal that almost nobody is tracking. Welcome back. I'm James. Today is February 14th, 2026. This channel breaks down precious metals using structure and mechanics, not hype, not predictions, just the forces that actually move price. If you're new, subscribe. It takes 1 second, and drop a comment right now. Just one word. Are you bullish or cautious on silver today? I want to see where this community stands heading into what I think is a defining week. If you're new, subscribe. It takes 1 second. And drop a comment right now. Just one word. Are you bullish or cautious on silver today? I want to see where this community stands heading into what I think is a defining week. Let's get into it. Here's the setup in 3 sentences. Silver, specifically microsilver July 2026 contract SILN6, closed near $78.85, up 1.29%, holding firm near recent highs while the CME margin environment tightens and the dollar drifts below 97. Now, a 1.29% day in silver is not headline material. Silver moves more than that on a slow Tuesday. But the context around that 1.29% is what makes it worth 15 minutes of your time. Because silver didn't just go up. It went up after being hit. And how a market responds to pressure tells you more about its health than any rally ever could. Let me explain what I mean by hit. The CME, the exchange that runs COMEX silver futures, has been tightening margin requirements. And I want to explain what that actually does in a way that makes it stick. Because if you don't understand margin mechanics, you're missing the single most important structural force acting on silver right now. Here's the simplest version. When you buy a silver futures contract, you don't pay the full value. You post a fraction called margin. It's a security deposit, collateral. The exchange holds it to make sure you can cover losses if the trade goes against you. Now here's the part most people miss. That deposit amount is not fixed forever. The exchange adjusts it based on volatility. When silver gets more volatile, the CME says this market is riskier now. We need more collateral from everyone. So they raise the margin. And every single person holding a silver futures position suddenly needs more cash in their account. For big institutions, that's a phone call. Wire more funds, done. For smaller traders using maximum leverage, it's a crisis. They were already stretched thin. Now the rules changed. They either find more money, shrink their position, or get liquidated by their broker. No negotiation, no grace period, market price, out. That's what a margin hike does. It shakes the tree, and whoever can't hold on falls off. The CME shook the tree. And silver didn't fall, it went up. So who fell off? And more importantly, who's still holding on? Because the identity of the remaining longs tells you everything about whether this rally continues or collapses. I'll show you exactly how to read that in a minute. First, the dollar. The DXY is trading around 96.85, below 97. And I've talked about the 97 level before, but today I want to frame it differently. 97 on the DXY is not a technical level in the traditional sense. There's no trend line there, no Fibonacci. It's a round number, a psychological anchor. And in macro markets, psychological anchors function as narrative switches. When the DXY is above 97, the default institutional narrative is dollar stable. Fund managers stay allocated in dollar assets. No urgency to diversify. Precious metals face a passive headwind because there's no reason to seek alternatives. When the DXY drops below 97 and stays there, the narrative switches. Not instantly, gradually, meeting by meeting, memo by memo. The conversation shifts from dollar stable to dollar weakening. And that shift triggers a slow, heavy rotation of institutional capital toward real assets. Gold, silver, commodities. This rotation is not fast, it's not dramatic, but it's enormous. We're talking about the world's largest pools of capital making allocation adjustments measured in billions. And those adjustments, once they begin, tend to continue for months because institutions don't flip positions daily, they implement gradually. The longer the DXY stays below 97, the more institutions classify this as a trend rather than a fluctuation. And the more they classify it as a trend, the more capital moves toward metals. Silver is a direct beneficiary of this flow, not just because of investment demand, because silver is priced in dollars. A weaker dollar makes silver cheaper for every buyer outside the United States. And that marginal demand, aggregated across every international market, is a powerful and persistent tailwind. So right now, silver has 2 things going for it. It survived a margin hike, which means the weak hands have been filtered out. And the dollar is below 97, which means a macro tailwind is building underneath. But here's the problem. I have 3 data gaps right now that prevent me from turning moderate conviction into high conviction. And one of those gaps is big enough that if it fills in the wrong direction, It could invalidate the entire bullish framework I just described. I'll tell you exactly which gaps they are and what I need to see. Let me lay them out transparently because this channel doesn't hide uncertainty behind confident language. Gap 1. The 10-year Treasury yield. I pull this from Fred DGS 10. The latest observation is not confirmed for this cycle, and yields matter because they represent the opportunity cost of holding silver. If the 10-year is softening below 4.15%, the bullish case gains macro confirmation. If it's reversed above 4.25%, silver has a headwind I can't see yet. This is the gap that could invalidate the thesis. Gap 2. PSLV Physical Holdings. Sprott's Physical Silver Trust reports how many ounces of actual metal sit in its vaults. Previous readings exceeded 216 million ounces, but I don't have a current update. Without it, I can't confirm whether the physical accumulation trend that provides silver's structural floor is continuing. Gap 3. QOT Positioning Detail. The February 3rd report shows the aggregate open interest structure, but the non-commercial versus commercial breakdown, the split that tells me how crowded speculative positioning has become relative to producer hedging, is not clearly readable in the futures. Only format this cycle. 3 gaps: yields, physical demand, positioning detail. I tell you every time because your analysis is only as good as your data, and right now my data is incomplete. But here's what I can work with. Price behavior. And price behavior, when read correctly, can compensate for data gaps by revealing what the underlying conditions probably look like. Silver's body language right now is telling me 3 things. 1. The buyers who remain after the margin hike are well capitalized. If they weren't, they'd have been forced out. Price would have dropped. It didn't. They stayed. That means the remaining long base can afford the higher margin costs. They're not leveraged to the edge. They have reserves. 2. The advance is measured, not frantic. Up 1.29%, not 5%. This isn't a speculative frenzy where everyone piles in chasing momentum. This is steady, deliberate accumulation. Someone is buying consistently without trying to move price. That's the behavior of patient capital building a position, not hot money chasing a trend. 3. The dollar weakness is providing a passive tailwind. Silver doesn't need new catalysts every day to hold these levels. The weakening dollar mechanically supports the price by making silver cheaper for international buyers. As long as the dollar cooperates, silver has a floor that doesn't require active defense by existing longs. These behavioral signals don't replace hard data, but they give me a working framework while the data gaps fill. Now let me give you 2 scenarios, because the setup can resolve either way. Scenario A. Bullish confirmation. Silver advances toward 80 and beyond. This becomes the base case if yields confirm softening below 4.15%, completing the dual tailwind with the weak dollar. If silver holds above 78 for 5 or more sessions after the margin hike, establishing a structural floor. If the DXY continues drifting toward 96, sustaining the institutional narrative shift. And if PSLV data when available shows continued physical accumulation. In scenario A, the margin hike was a filter that strengthened the market. The dollar tailwind provides steady fuel, and silver's consolidation near 79 is the base camp for a push toward 80 and the round number zones above. Scenario B. The data gaps bite. The missing information reveals a weaker setup than price behavior implies. This triggers if yields have actually reversed above 4.25%, reintroducing a significant opportunity cost headwind. If the dollar bounces back above 97, killing the tailwind. If the CME raises margins again, compounding the capital drain on remaining longs. And if open interest in the next COT declines, showing that the margin hike is having a delayed effect and participation is eroding. In scenario B, silver's holding pattern wasn't strength. It was the calm before the data catches up. And when it does, the correction takes price back towards 74 to 76 to find real support. I lean towards scenario A based on behavioral signals, but leaning is not certainty, and the data gaps keep my conviction at moderate. There's one specific thing I'm watching that could tip the balance definitively towards scenario A. It doesn't come from the futures market, it comes from the physical layer. And if it triggers, it would tell me the buyers driving this market are not speculators at all, they're accumulators. And accumulators don't sell. It's point number 5 on my checklist. Here it is. 5 things I'm watching, starting right now. Number 1, 10-year Treasury yield from Fred DGS 10. Priority 1. Below 4.15% confirms the macro setup. Above 4.25% challenges it. I update the moment this data drops. Number 2, Sessions silver holds above 78 post-margin hike. This is the resilience clock. Each day above 78 builds the floor. A break below resets the count and shifts the framework. Number 3, DXY weekly close position. A weekly close below 97 for consecutive weeks confirms the institutional trend classification. That's heavy. That moves capital. Number 4, next caught open interest reading. Stable or rising means the margin hike was absorbed. Declining means attrition. Simple. Number 5, PSLV adding ounces during price consolidation. This is the signal. When a physical trust adds metal while price is flat or pulling back, it means the buyers are not chasing momentum. They're accumulating on stillness. That's conviction capital, the kind that doesn't sell on a 2% dip, the kind that doesn't respond to margin hikes, the kind that provides a floor so structural that paper selling bounces off it. If PSLV shows growth during this consolidation phase, the bullish case goes from moderate to strong. That's the checklist. 5 items. Each one fills a gap or confirms a signal. Let me close with this. Silver doing nothing dramatic at $79 is the most informative thing it could be doing right now. It survived a margin hike. The weak hands were filtered out, the dollar is cooperating, and the remaining buyers are showing the kind of quiet, measured, patient behavior that characterizes the early stages of structural moves. My stance is bullish, moderate conviction, pending data confirmation on yields, physical demand, and positioning. This is education only, not financial advice. Always manage your own risk. 2 questions for you. Question 1. Binary choice. Is silver's hold above 78 after the margin hike strength or illusion? 1 word. Strength or illusion. Question 2. Pick one of 3. Which data gap matters most to you personally? A. The 10-year yield. B. PSLV physical holdings. C. Detailed COT breakdown. Pick one. Tell me why. I read every comment. Your answers shape the next video. I'm James, February 14th, 2026. Silver is holding, the dollar is soft, the data is incomplete, and the market's body language is speaking clearly to anyone willing to listen. Stay patient, stay disciplined. Count the days above 78. I'll see you in the next one.